Hi, Woody here with the first of what I plan to be many strategy sessions with our editors here at Port Phillip Publishing and Fat Tail Media for the New Look Insider. Now, the idea is pretty simple. We have a wealth of incredible talent and experience among our analysts and editors. And each day, their mission when they come to work, their job is pretty simple and pretty focused. And that is to think very hard on your behalf to figure out what's going on in the world of finance and money and investing, and to provide you with ideas and solutions that aim to give you an advantage that you just don't hear in the mainstream. Because most people in the mainstream don't use this thing in between their ears. It's much easier to go along with conventional ideas and conventional thinking, but it doesn't get you very far. And perhaps it can do for a while, but as we've seen lately, things can change extremely quickly. Now, as you know, we don't really have a company line here at Port Phillip or Fat Tail Media. All of our editors have very different ideas and strategies for how you can get ahead, whether that be ahead of opportunities or indeed market threats that pose potentially big risks to your wealth, savings, and perhaps plans for the immediate and long-term future. So the only requirement we stipulate is that the ideas that we publish are thoroughly researched and thought-provoking and offer you a genuinely different and valuable perspective. So that's what we'd like to do, to use this time going forward and over the coming weeks as we begin today with none other than Murray Dawes. Murray, welcome, buddy.
G'day, Woody.
Now, you're not going to be, you're familiar with the Port Phillip Insider readers. You usually do your thing on a Monday and you take them through the markets.
A week ahead thing, which hopefully a few of them are watching.
Yep. Well, so I figured because we're going to re-engage a few readers that haven't read it for a while, or perhaps there's some new readers come on board. Do you just want to start by giving a bit of background for your experience and how you cut your teeth trading? Because that's what you do. You're the trader amongst us.
Yeah. Well, look, I started way back in the early 90s on the futures floor in Sydney. So I got a graduate position with Swiss Banking Corporation. They were called SBC Deminx Barry at the time. They'd taken over a small operation in Australia. So it was all very early days of all those international banks moving into the Australian finance market. And I was a graduate there and they put me straight onto the futures floor. So I was, in the pits with the funny coloured jackets and yelling and screaming. And it was a real starting in the fire, I guess I could say. It was pretty amazing experience as a young kid. To be thrown into the thick of markets, and it was quite exciting, and that's where I fell in love with the markets, in love with trading. And I spent about nearly 5 years on the floor there, and was starting to build my own ideas and strategies based on spending every day watching the markets trade.
Yep.
And then sort of left there and was building my model and got asked to move down to Melbourne to trade for one of the wealthiest families in Australia.
And how long did you do that for?
A couple of years. That was around the time of the 9/11. That's it.
Which came off the tech bus, so you probably traded through it in the aftermath.
9/11. Yeah, I started. It was at the time when things really got pretty hairy, and going into the start of the Iraq War and that sort of thing. So it was pretty wild markets. So I really cut my teeth there, trading quite large account sizes.
Yep.
And then headed off and was broking to hedge funds and got asked again by high net worth guys to trade the market for them for years. And then ended up meeting the guys at Port Phillip and sort of started a thing, years ago, as you know.
Slipstream trader, I remember it well.
Yeah, that's it. So, I've been around the track for quite a while.
So at what point, so you kind of use fundamental analysis as well as technical analysis, don't you?
Yeah.
Well, did you start in any one field, or have you always had like the fundamental picture in mind as well?
Well, I was always interested in macroeconomics. I remember on the futures floor, I used to walk around with these big, thick pads of macroeconomic theory, and they'd weigh down my jacket, and everyone used to make fun of me because my jacket was completely lopsided while I was walking around on the floor. So I was really interested in that sort of big picture economic theory, and had studied business, a double degree in accounting, finance. So I sort of had that background and was interested in the business analysis. But it was on the floor that I got really interested in technical analysis, because I mean, seeing people, going from calm to absolute panic in moments, and seeing all the local traders just absolutely needing to get out of their positions no matter what, because some news came out or whatever. You started to see that there was all of these different emotional reactions that were going on in the way people were trading. It wasn't just a logical analysis of what something was valued at and let's buy it here and sell it here. It was, oh my God, there's a news out. Oh, I'm in a bad position. I put on too much. I'd better get out. So there was a lot more of that going on than what you'd think would be rational decision making. So I got interested in seeing just the same sort of things happening. And for me, it was the false breaks. It was looking like things were breaking out. Amateur traders would buy it thinking that they were going to make money. Then all of a sudden the music stopped and they were scrambling out of their position only minutes later for the short-term traders. So this constant false breaks was constantly creating problems for traders. And I thought, well, maybe you can actually use that to make money.
So just explain the false break then. You say a vast number of people react in a certain way when they see a break happen. So what do you just explain that expression?
Classical technical analysis would look at a breakout. So let's say, the price of the stock's $3.50 and maybe the highest price it's been for a year is $4. So everyone's looking at that $4 going, well, if it breaks above $4 and that's the all-time high, it might go up to $5. So a lot of people are looking at those sort of key levels, and when they break above them, a lot of people think, oh, that's bullish, I'd better buy. But often markets will go up and test those levels and break out above them and then fail and return back to some sort of mean, an average price where prices have been oscillating around for a long time. So before a market's ready to really trend, it'll often spend a lot of time just shaking traders out, and then it will trend just when you least expect it. So I think people, have a linear way of seeing the market, that, it's trending up or it's trending down, but the actual price action is a lot more complex. And it really does stuff traders up. This is why people lose money, is the way price action moves. And my theory is based on trying to take advantage of it rather than getting caught up in it.
I know there's been a number of events which have brought you to this point and helped you define your strategy. And I remember we held we used to call it the Doomers Ball, and where this was back in 2012. It was in Melbourne, and actually no, it was the end of 2011, and it was in Melbourne. It was a free event that we invited all our readers for at the time, and one of the most engaging presentations was your one, and it was a big lesson that you learned. And I guess, do you want to explain that, because it kind of embodies the false break and it shows people?
Yeah, absolutely. Look, this is early days for me in my strategy development, but I guess it is a pretty interesting one to go through. It's a bit painful for me to go through it again and tell you, but
it was the trade that got away, right?
Oh God, was it ever? Look, I'll show you quickly. If you can see it here, can you see it all?
Yep.
Yeah, right. So this is basically the S&P 500 back in the day, during the crash.
So when you refer to the crash, we're talking back in 2007, right?
Yeah, 07 to 08. Yeah, correct. So late 07, all of 08. So this is actually the all-time high in the S&P in late 07. So you can see there 2008 down there.
Yeah.
So this is sort of the beginning of the crash, and this is a daily chart. And the actual Lehman event, funnily enough, is actually here. So
when you say the Lehman event, you mean
when Lehman went under.
Yeah.
So Lehman went,
causing an absolute cataclysmic crash in the market.
Correct. So this is actually the price action where this was the weekend going into Lehman, and this is the first few days after Lehman came out. So you can see a really big sharp sell-off there in prices. Now, when I was trading, I'd actually gone pretty well, and I'd been getting short from up here and had made quite a bit of money on this leg down, and that was from May to July. So because I'd had a pretty good run, I was starting to buy options. I thought the market was going to continue selling off. So I was trying to work my way into option positions, buying put options, where you've got the right to sell. So you make money if the market falls. And coming into Lehman, this is on this weekend here, I actually owned about 20 S&P puts, which expired in 4 days, right? 4 or 5 days. A Friday morning, they expired. And when I woke up on the Monday and the Lehman news came out, I was pretty damn happy, as you can imagine. So I had about, it was like a 12.25 strike. So basically I would make money every point that prices fell.
Yep.
And I only had 4 days to go. So I had about 20 of them. So, and it's $50 a point. So I was making 1,000 US a point. And the Aussie dollar was at about 80 cents at the time. So, you know, about 1,200 or more Aussie dollars a point. And the next few days happened, and Wednesday night came, and it was all the way down here at about 11.50 it was actually at, down here. So I was nearly 80 points in the money by this stage, which is about 100 grand Aussie. So you can imagine how happy I was on Wednesday night before I went to bed, with prices absolutely free falling. And I had 1 day to go before the options expired. So I went to bed, you know, pretty early in the morning, and it was free falling, and I was just cheering. And I thought, well, I don't know where this is going to be when I wake up, but it's going to be bad. So I'm going to let it go for another day, make as much as I can. And then the plan was to keep buying put options in the market as the prices kept falling by the next strike, you know, because this was coming into September. So then I'd buy the December puts.
Yep.
So I went to bed, I don't know, 2, 3 in the morning, and was up about 100 grand Aussie on the position, and they expired in a day. And I was way in the money. So I thought I'm home and host. And then the next day I woke up and, you know, wandered into my office to check what had happened overnight. And this had happened. So this move here, so it had gone from 1140 all the way up to nearly 1300. So about 150 point rally. It was about a 15% overnight rally, because Bush had come out a few hours after I went to bed and had announced TARP, the massive bailout of the banks. Nearly $1 trillion worth or something, 700 billion, I think it was at the time. So my options expired worthless. So that was 100 grand up the tube from the time I went to bed to the time I woke up in the morning. And basically, if I'd kept rolling those puts, if I just sold those puts and bought the December puts with the money that I'd made on that night when I went to bed, well, that's what came next. So I would have been up over 500,000 Aussie within a number of weeks on the option position that I had on. So that 1 day rally overnight from the time I went to bed to the time I woke up on that announcement basically ripped a huge amount of money out of my pocket. And I still remember it to this day.
So what did it teach you about your strategy that you have today? Because it taught you a profound lesson, right, about risk management, didn't it?
Well, I think, yeah, basically anything can happen. Don't ever get into a position where you think she'll be right, mate, and it's absolutely fine, and I'm definitely on a winner, and it's absolutely, I know what's going to happen. You don't. If someone comes out with the biggest bailout of banks in history 2 hours after you go to bed, you're stuffed. So the market is incredibly volatile. We don't know the future. And this is the key thing that I guess I changed my way of thinking, was when I went from thinking I'm trying to work out what the future, what the future is, that, all the work I do is trying to work out what's coming next. But now I don't think that way. I think what I'm trying to do is to use price action to get into really low risk positions where I've taken part profit and I create a free option and see what happens next, because I know I don't know the future. So it's about
just explain that concept of the free option. What do you mean? Because it's quite a technical concept, but it's actually a really, really powerful risk management tool.
Yeah,
and it's one that viewers could actually probably take away and implement it as well, or take the idea. So if you could just explain it, that'd be really good.
Okay, well, I'm still sharing the screen, aren't I? So I'll just quickly use the screen to show you what I mean. So if I look at this price action that happened here in the S&P, back in the time, we've got all this movement, right? Sideways movement around this midpoint of the range, which I call the point of control.
Yep.
And that's like an oscillation where they're trying to decide, are we going to break to the upside or are we going to fail to the downside? Now, we don't know. What we do know, by understanding how these distributions form, is that we often visit that midpoint. So in my risk management, where I look to, sell the false breaks, so we have the high of the range here. See how prices tried to rally above the high there and looked good, and then failed. Couldn't carry on with it. Now, what happened after that? Prices fell straight back to that midpoint. So in my risk management, what I try to do, if I was bearish and I wanted to get short this index, for example, and I'm looking at this range here, I'm looking at the midpoint of the range, and I'm saying there's a pretty high probability if this false break happens, we're probably going to go at least to that midpoint. So what I want to do is set up a trade where I say I get short and I take part profit at that midpoint. So I take a third profit. So what I do is I'll get that highest probability move. I'll take a third profit and then I'll adjust my stop loss on the remainder to a break-even level for the whole trade. So once we've hit that initial point, which is the highest probability point, we're either going to break even or make money. And that is similar to a free call option. It's like, imagine if you had a free call option where, you make money if the price goes up, but you don't lose any money if it goes down. I mean, that's a pretty good set of outcomes, rather than fretting every day, am I going to make money? Am I going to lose money? So it's trying to get to that point where you can stop stressing. And one of the other major aspects of it is, if I've taken that part profit, so let's say I got short here. Let's say I got short here and I take part profit at that midpoint. Well, my average price is going to be up around here, right? Which is going to be up near the high of the whole range. So if prices did bounce off this midpoint and go up through the high, I don't really want to be short, do I? Because prices could rally a long way. So I want to make sure my stop loss is at a point where I'm happy to get out. I'm happy to say, okay, I'm wrong. So that's it's a double-pronged thing of using this, taking the part profit quickly. It makes sure that my average price on the whole position is at a point where I'm happy to get out. I'm happy to say that I'm wrong.
So how are you finding the latest volatility? I mean, markets, what are you making of the markets right now? I mean, they're up about 15% from the March lows, roughly. Yep. We're talking on Thursday, by the way. This will be going out on a Friday. But as of now, it's around 15% of the March lows after a huge COVID, historic bear market, which seems, I don't know if it's over. I don't know what your thoughts are. If you give us.
Well, I mean, I sent out a video on Monday which people can check out, which was that I thought prices were bumping up against some pretty serious resistance.
And why is that?
Well, it's based on, again, my strategy on looking at these buy and sell pivots, on how markets change direction. So we've got the monthly sell pivot, and that's, if prices are marching higher and higher, the first thing you need to see before prices are turning down is you need to see a close below the low of that highest price candle. So that's the first sign that maybe, there's enough selling pressure to overcome that buying strength. So once I've got that, though, I think a lot of amateur traders look at those things, but they don't trade them in the way I do, which is that I wait for that to happen, but then I wait again and I wait for a squeeze after I've got that confirmation of the big picture momentum shift. Then I wait for those other short-term traders who got short, on the way down, they get squeezed out. So we'll see another final rally, which is what I see this rally as, which goes up into the selling pressure. And there'll be a lot of selling pressure above the market, because remember, all of a sudden, everyone was out of the money, right? Years of buying was all of a sudden out of the money at that crash low. So this rally, a lot of people are going to see it as a potential opportunity to lower their risk a bit, just in case it does fall over again. So there's going to be selling pressure above here. And I've got calculations based on the last month's range where I have seen there is often selling pressure where I find opportunities. And then I wait for shorter term selling pressure, sell pivots, within that range, and then I can start trading. So it's all very clear cut, what I do.
How far are we away from the area where you see the strongest selling pressure, or are we there right now?
Well, we actually hit it at the start of the week, which is why
Right.
on Monday I said there should be selling pressure around here. And then we saw this week the big sell-off. And last night we had a bit of a rally, but now that rally is going up into the shorter term selling pressure. So this can all roll over very quickly. And the next thing when prices will really sell off hard is if we have the weekly sell pivot. So now I'm looking at the low of last week's range, which is around 27.11, I think, in the S&P. If the week closes below that level, that will confirm a weekly sell pivot. So that'll be a weekly sell pivot from the monthly selling pressure. So that's like, watch out. That's when momentum can really shift back to the downside.
And is that kind of similar to what you saw back in early March, late Feb?
Yeah, well, it's quite similar, but the market was so much stronger then, because I ended up taking profits on positions when we first had a bit of selling pressure. And yeah, we had a weekly sell pivot and we had the first news of the COVID issue rising. And I had a lot of long positions on at the time that were quite well in the money. So I did, thankfully, sell a bunch of them, take a bit of profit out of them at the time. Probably not enough, like always, you wish you just sold them all. But still, we took a whole bunch of profits at the time, and that really put us in good stead for when things did collapse.
What do you make of all the well, I was chatting to Jim Rickards the other day, and I kind of referred to the huge, unprecedented stimulus packages that, America's doing. But his point was they're not stimulus packages because they're not stimulating anything. What are your thoughts on that, seeing as that you've experienced what a stimulus package can do firsthand, and it costs you almost $500,000 in lost profits? Does it surprise you anymore about what central banks try and do?
No, I mean, and the thing is, they've got to get bigger and bigger the more time that goes on. I was chatting with a trader friend of mine yesterday, and I was talking about my research of the inflation that happened after the French Revolution, and it took about 7 years to completely take hold. And what would happen would be they'd inflate with some money, and then it would be fine for 2 years. Right, but then everything would start slowing down again. So then they'd start inflating again, but they'd need to use more to get it back to where it was. So then they'd do more, but then it would only last for another year or so, year and a half. So the first one went for 2 years, next one, a year and a half. Oh shit, we've got to do more. So then they'd have to do more. So then by the end of it, after 7 years, it was 6 months, and they'd have to do double the amount that they did 6 months ago. And all of a sudden the inflation really took off and things went completely pear-shaped. So in these sorts of things, the more this goes on, they're going to have to keep doing more. And at the moment, the Fed's balance sheet is increasing at an absolutely amazing rate of knots. So, where this goes, who knows? I've seen so much in the last 10 years with them being able to reinflate it from the crash lows, that you just can't put anything past them of what they can do and how much they can turn the market around. So the old adage, don't fight the Fed, is real.
Yeah.
But there's going to be pressure's going to come out of a valve in some point. So either the US bonds are going to possibly come under pressure because of the huge amount of supply that's coming. Can they monetize enough to really keep a lid on the long bond? If not, it'll be US dollar. Does the US dollar then turn back down, or gold really taking off? So you're going to see there's going to be pressure valves somehow on what they're doing that are going to show you. And I'm just waiting to see which it is. I'm very long gold at the moment. I think it can really go because it is that what they're doing with their balance sheet right now and worldwide to try to stem this after already a decade of doing this sort of stuff and debt to GDP levels already at extreme levels. I mean, this is a point when things can unravel a bit. So, it's quite interesting.
Greg spent Wednesday talking about the oil market. I mean, there's been historic crashes in that sector too. Is that something you follow as well, or? Yeah,
no, I'm keeping an eye on it. I mean, it's huge, of course. I mean, when everyone's sitting at home, how many people are driving? When you've got 60 to 70% of people driving cars not doing it anymore, all of a sudden demand's crashed. I mean, I just read this morning there's about 50 million barrels on the way from Saudi Arabia to America right now, and they're already pretty much full up. And they're trying to crash the US oil shale, of course. So maybe Trump comes out in the next few days and bans Saudi oil to try to save the US shale. And if US shale goes under, look at all the loans that are going to blow up the banks that have spent billions lending to that sector. So there's all of these undercurrents that can blow things up. There's all of these hidden, or the shoes that are going to drop at some point. And I just think that's why we're possibly going to see another leg down, is that I think there are, you know, who's been swimming naked? Who are the big funds or businesses or whatever that are going to start coming under pressure? And the banks, of course, at being the final point where all the risk goes to, they're the ones that are under pressure, because that's where all the losses end up happening, for people can't pay their mortgage, or businesses can't pay their loans or whatever. So the banks are under a lot of pressure in our market, and possibly have further to fall. But ultimately, I want to buy them. So if the banks fall far enough, this could be a once in a generation opportunity to get along the banks.
So, because I remember back in the day, and I know you'd be the first to admit this too, you, in the past, you told me personally that, you know, sometimes one mistake you've made is letting your overarching bearish outlook get in the way of your trades. So you fix that now, right?
Yep, that's it. Well, this is it. This is why I have such a technical model to get rid of that. So if I've got the, quarterly sell pivot or the monthly sell pivot, I'm allowed to be more bearish here. While the monthly sell pivot, while it's a monthly buy pivot, the most recent, watch out. So I'm able to just have a model that looks across all time scales that can set up for me what my position is, and where, really I'm just looking to create trades. I don't care whether I'm buying or selling, as long as I've got a good opportunity for it to do a mean reversion back to a point. If I know there's a high probability that some stock's going to go from $5 to $5.50 on a mean reversion quite quickly, I mean, why not buy it, take part profit at $5.50, and then have a stop loss at $4.75 and see what happens? Yeah. Because what if it rallies? What's the worst outcome? You break even. So if I can get a high probability outcome that I'm going to get at least that little bit, I don't really care. I'll like the stock. I'll do lots of fundamental research, and this is the thing. I do a lot of fundamental research. That's most of my time is spent doing the fundamental research, because my technical model's set in stone. So all of my time is I do a scan every month, which is based on an algorithm I've written looking for my technical setup. And then that'll throw up 50 to 100 even stocks sometimes. And then I'll go through, look at all those charts and whittle that down to maybe, 20, 30 stocks or so that I'll think, okay, these are candidates. And then I have to do the legwork of the fundamental analysis on each and every one of those companies. And then I whittle that list down to maybe 5 that then go onto my hot list, and then I'm waiting for the opportunity to trade them.
And that's how you achieved 84% strike rate in 2019, right?
Yeah. That's pretty much it. I mean, that's the thing. It's a lot of work that goes into that, because I wasn't trading a lot. I'm maybe only getting a trade out once every 3 weeks to 4 weeks. But there's, I've researched 50 companies to come to that one.
That one trade. Oh, cool. Well, you currently got a workshop that's currently in the process of being, I think by the time we finish this recording, the doors will be open to Pivot Trader. So if people want to check it out, there's a link below this video, which you can check out.
Yep. And check out the Monday videos too, because if they've got access.
Absolutely, yeah. You tell us, you basically give away 95% of what you do in those videos each week.
I give away a lot of the theory, because it is my theory, and I know that people haven't heard about it before. But of course, I keep the real nuts and bolts. But that's only a final piece that creates the real edge, and they learn about that once they become a member of Pivot Trader. Yep. But if they want to understand my thinking of how I think, then look at those PPI Monday videos. I mean, 2 weeks ago, I said there's going to be a short squeeze coming, and that next week, the market had the biggest rally since 1974. And it doesn't mean I knew that was going to happen, but based on my model, it was saying this is what should happen now.
So perhaps let's finish on there, Murray. What do you think is going to happen in the next week? What is your system saying, or what are you looking out for?
Yeah, look,
what can viewers take away?
Right now, I think there's a higher level in the S&P, which I really hope it gets to, right? So at the moment, it's trading around 2,800 odd. And it has actually found resistance at the 20-month moving average and also the sell zone of the monthly sell pivot candle. So that's my first point, right? So it can actually sell off from here. And I'm almost hoping it doesn't because I haven't got a big enough short position on yet. But then there's another level above that, which is around 3,000 to 3,080. And I explain it in the videos on the Mondays if they want to check it out, which that's my sort of holy grail area. So if we can have one final squeeze up there, I'll be going hammer and tongs at it from the short side. But I actually am a bit wary that it could turn back down tonight, the next 2 nights, and create that weekly sell pivot that I was telling you about. And if it does that, then momentum can shift back down pretty quickly. So big picture is I'm looking for shorting opportunities and I think it's going to sell off, but we might be in for one final squeeze to really get the shorts concerned before turning back down. So all up pretty bearish and looking for those shorting opportunities.
Oh, there you go. Cheers, Murray. Well, I guess we'll find out on Monday if the situation has changed or developed.
Yeah, if that weekly sell pivot happens, then I know what to do. You know, it's all set in stone.
Cool. Okay, we'll leave it at there then. Cheers, Murray.
Well, mate.
I've got quite a few editors to get through. You're the first one. Next Friday, I think we're going to be talking to Vern Gowdy. And after that, perhaps Ryan Dintz. And there's a big event coming on called the Bitcoin Halvening. So we'll be touching on that in a few weeks' time. But cheers, Murray. Thanks for your time. And yeah.
Awesome.
Take care. Cheers.
Cheers, buddy.